Hello, everyone. On this Retirement Planners of America podcast, we're going to have more fun than a human being should be allowed to have when talking about income and estate tax planning. Ugh. But guess what? A lot of this stuff, if you don't use it, you lose it. And we're going to talk about how potentially to save thousands of dollars in taxes. So stay tuned.
Retirement Planners of America, RPOA.com.
Hello, everyone, and welcome to the Retirement Planners of America podcast. As always, I hope it finds you healthy, wealthy, and wise. And I am the founder and CEO of Retirement Planners of America. And we work primarily with people who are over 50, who are retired or retiring soon. And in this podcast, we're going to be talking about year-end tax moves that you should think about, because a lot of them, if you don't use them, you'll lose them. So we want to make sure you don't lose them. And we're going to have more fun than a human being should be allowed to have when talking about all of this boring financial stuff. So we're going to get started, and so let me bring in Jeremy, my sidekick here. Jeremy, how are you doing?
I'm fantastic. How are you doing?
I am doing well. You know what? This is December.
Yes, it is.
And it is, for me, the most fun part of I love going to the mall. Mm-hmm. I love having to drive around for 10 minutes to find a parking spot. I love getting caught in all of that and not finding the people, the crowd. I love all of it.
The energy.
I love it.
Yeah. Yeah.
You know, this online stuff, it's just antiseptic. I don't like it. What do you think?
I love the people aspect of everything, feeling everyone's energizing, kind of waves out when you're around everyone else, and where you're on a phone or you're on your computer, whatever. It feels pretty boring and bland.
But you said that you wish that...
let's shop all year round. What are you talking about? Christmas shopping is not just for December.
No, it shouldn't be.
No.
It should be year-round.
It's year-round. You should be shopping for Christmas all year round. Listen, if you're looking for... I'm a deal searcher. I love a bargain. If you're going to find a deal during Christmas time, it's not going to happen. You're going to find that deal in July.
You're right. You're right about that. It's kind of like buying ski clothes in July and then not waiting till ski season, and then all of a sudden the prices are through the roof.
Absolutely.
I agree with you, but I'm a last-minute shopper, and so I go there and I'm like, please have what I want.
Where's the Furby?
Yeah. All right, so we're going to talk about year-end tax savings moves in this podcast. I think they're very important. And we've got 10 of them.
Yes.
And this is part one.
Yes.
And so part two, we're going to ask you to watch separately. We're going to tease you guys on that. So you're a tax expert on this, aren't you?
I am not qualified to talk about taxes, but I am qualified to pay taxes, apparently.
Well, that's a good thing. I like
that. But you are. You're qualified to talk about it.
Okay. Let's see if I am.
Let's test that theory, right?
Let's give it a shot.
Okay, so end of year taxes, everyone talks about, get your taxes right, all that kind of stuff. Why is it so important to do before December 31st? Why is it, it can't make that big of an impact, can it?
Oh, yes, it can.
Oh, okay.
We're going to go through 10 different things.
Okay.
And I can tell you that several of them, if you don't get them done before the year end, they're kind of you use it or you lose it.
Oh, wow.
So it's not a renewable resource.
Yes.
And, my belief system is that anytime, you should always pay what you're legally required to do.
Of course.
Okay, so you should not do anything illegal.
Right.
But anything that is legal, you should max the heck out of.
Okay.
You should it is your duty to pay the least amount of tax possible legally.
Well, don't you kind of make those changes during tax time when you're filing? Why do I need to worry about this now? Why don't I worry about that or my tax guy or myself when I'm filing myself? When do I fix it then?
Jeremy, you're not listening to me. It's too late by that. If you're filing in April for last year, it's too late on a lot of these things.
Okay.
You can't do them.
Okay, so super important.
Yes.
Timeliness is of the most importance here.
Timeliness is of the essence. Yes.
Okay.
Yes.
Okay. Very good. Okay. Well, let's talk about a couple of those items then.
All right. I'm ready.
So 401k contribution, you've been contributing to that all year long. That's kind of a lot of people rely on that for their retirement.
Yes. And the thing about 401ks is that they are absolutely fantastic.
Yeah.
And you should be maxing out on that to the extent that you can every single year. It is the most powerful wealth builder that I can think of. The return on investment is this. You put $1 in, potentially you get a match and potentially you get a tax deduction. You add those two together, and your return on investment, you put $1 in, you get over probably $25 in tax deductions and tax savings.
Wow.
So your return on investment, before it even earns anything in the investment you put it in, is over 20%.
That's a really good investment.
It is fantastic,
Yeah.
and we're good, okay?
Yeah.
Don't get me wrong.
Right.
But I can't even come close to that.
Absolutely.
You know, I mean, this is just by doing it, you make that. And then the investment itself adds to that. So you
Right.
could be upwards of 30% return on your money by doing it. There are very few things that can do that for you.
Absolutely.
So maxing out on your 401k contributions is super important.
Okay, maxing out.
Yeah.
What does that mean? Does that mean the same thing for everyone?
Well, no, and I put the rules in front of me. So for everybody, the max for this year, 2025, is $23,500.
Okay.
Okay, so you want to make sure you max that. Now, for those of you that are over 50, you get what's called a catch-up provision. The idea being that you have been procrastinating, you haven't done it, you know, for whatever the reason is.
Absolutely.
And so you get an additional amount. So you actually can go up to $31,000.
Okay. That's a sizable increase.
It's a sizable increase. And then you've got an additional, if you're between 60 and 63,
very specific.
which is a very specific time period, yes, then you can go all the way up to 35,000.
Okay.
And if you're beyond 63, then there's no catch-up provision. You're back to the
Right.
23,500.
Okay, so you have that. What is the catch-up provision for? Like, I get it, like you're trying to, I guess, catch up.
Yeah.
And trying to like add on those final, because those are going to be your likely over 50, the most money you've ever made.
Exactly.
In your lifetime.
Yeah. And so people in their early years may have put in less than they could have. And now, theoretically, in your 50s, you're your highest earning years. And that being the case now, you want to catch up for
Yeah.
what you didn't do earlier.
Yeah.
So they give you these catch-up provisions, and they're assuming that people within that 60 and 63 are the biggest procrastinators and the
Yeah,
ones who
right,
have the
yeah.
most catch-up to do.
Absolutely.
So they really gave you a big bump.
Yeah.
But make sure you max out on that. It is, you know, it's magical.
Yeah.
I highly, highly recommend that.
Then it's not too late.
Unless the year's over.
Well, unless the year's, well,
You
it's,
can't-
it's not too late in December.
Right. I mean, you
Yeah.
could, but if you wait till January, then
Yes.
it's done. You can't.
Absolutely.
Yeah.
So,
make sure if you have not maxed out, you talk to your HR department.
okay. So talking about maxing out a 401k. So tell us about the traditional versus the Roth IRA, if you're eligible.
Yeah.
Essentially.
This is another thing. So this is another goodie, I'll say, that our government has given us. I hate saying that. They've given us.
Yeah, you're
okay.
welcome. You can have your money.
But IRAs have been around for a very long time. Roth IRAs are newer, but they've been around for a long time too. Both of them allow for the money that you put into it to grow without being taxed. And the difference is that in a traditional IRA, you get a deduction for putting the money in, and when it comes out, it's taxable to you in most cases. The Roth IRA is kind of the opposite of that. You get no deductions for putting it in, but when you take it out, it's tax-free. So there are some considerations there as to will I be in a higher bracket later than I am today, or vice versa, as to which one's better, which we
Right.
won't get into today.
Right.
But the key thing is that in many cases, you can do not only your 401k, but you can do an IRA as well.
Yeah.
If you really want to pin your ears back and save for retirement in a big way, then you can potentially do both.
Yeah.
But again, you can't make next year's or this year's contribution next year.
Right.
In most cases, you're done. If the December 31st rolls over, you're done. So make sure you're maxing out on all of these things if you can.
And the rules change year to year a lot of times.
They do.
Right?
They do.
Yeah.
Now, with these things, the good news on that is that they have increased in a positive way.
Right.
The amount that you can contribute has gone up over the years, but you never know.
Yes, absolutely. Okay, so talk about taxes, talk about 401ks, traditional and Roth IRAs. Let's talk about tax loss harvesting and what does that mean and how can people actually do it?
I'm impressed that you could even say that.
It's pretty easy when it's written down, right?
Yeah, so tax loss harvesting is one of my favorite things to do with clients at the end of the year. You can do it during the year also. But generally speaking, the attention is at the end of the year. So basically, tax loss harvesting means that you have gains and you have losses. And so what you want to do is, if you have investments that have lost money, you want to sell those.
Okay.
Basically, what you're doing when you do that is you are realizing the loss.
Yes.
So now you're showing a loss.
Yes.
And that then can offset a gain that you have. So that way you're ending up with a lesser tax by using the losses that you have. And if you are diversified, the likelihood is that somewhere in your portfolio you have things that have made money and some things that have lost.
Right.
So tax loss harvesting says, let's sell those things where you've made your gains, and let's apply losses rather, and let's apply those losses to your gains.
Right.
Now, if you do that, it may be an investment that is a favorite of yours.
Yes.
Right? And you're thinking, I don't want to sell that because I want to have it.
Right.
Well, you can sell it and then rebuy it.
Yeah.
However, you have to wait 30 days to do that. Okay? Because if you buy it back within that 30 days, then they're going to say, well, all you're trying to do is mess around with the tax code, right? So you have to wait for 30 days, and if you do that, then you're in good shape. So what we do with clients, if we do tax loss harvesting, is we put on the calendar, we're going to buy it back in 30 days, and then in 30 days we buy it back.
Okay, that's
or
very.
on the 31st day.
Yeah, so realizing that loss and then reducing the amount of income that you had or the gains. Okay, that's very interesting.
And it's fun too.
Yeah.
Believe it or not, it is. It may not sound like fun, but when you see that, wow, I could actually save like $3,000 in taxes or more.
Right.
That becomes fun.
That I like the idea of that. Okay, so heading into the end of the year, all the markets done, whatever the markets do, ups and downs and all that kind of stuff, and maybe we've our stocks are more profitable than our bonds. We end up with a larger share of stocks than we do bonds because we have a certain balance that we want to keep.
That's
right?
correct. Yes.
Why is it important to rebalance that portfolio as we're heading into next year, into 2026?
Yeah. Now, this isn't necessarily a tax-saving technique.
Right.
This is a risk mitigation technique.
Okay.
But we're throwing it into the mix just for fun.
Absolutely.
So what rebalancing means is that, let's say you've decided that your risk profile is for you to be 50% in stocks and 50% in bonds. And I'm using that just as an example.
Right.
To make the math easy. So you have $100 and you invested it 50-50, so you got $50 in stocks and $50 in bonds. The year end comes along and you look at your portfolio and now you are $60 in stocks and $40 in bonds. So now you are in a much higher risk profile than what you decided you wanted to be in, right? You decided you wanted to be 50-50, but now you're 60-40. So that's called risk creep.
Okay.
Which is a good one for Halloween, right? It's creep.
Yeah. What are you dressed up as? I'm a risk creep. Like, okay.
So you don't want your portfolio to morph into something without your permission, right? Now, if you decide, okay, I want to be 60-40, then you leave it alone.
Sure.
But you do want to visit it because you don't want your portfolio to creep up on the amount of risk you're taking that is no longer appropriate for you.
Absolutely.
Okay, so rebalancing is a strategy to make sure that the portfolio you decided, the risk profile you decided upon, remains constant over time.
Right.
Now, we recommend that you rebalance quarterly.
Yes.
But if you haven't done it all year,
Yeah.
then you should do it at the end of the year.
Absolutely. That was going to be my next question, is how often? You shouldn't do that probably every week, right?
I mean, there are studies that show, doing it daily, doing it weekly, monthly, and all that. The marginal difference is very, very small.
Okay.
But I'll say the cost from a time standpoint and potentially from a transaction cost standpoint of doing it does not make it worth doing. Quarterly is sufficient.
Okay. Yeah, that's great. And if you haven't done it, you probably need to take a look at it.
Yeah, you should look at it.
Yeah. Okay, so we're going to talk about a little bit back into tax planning again.
Okay.
Let's talk about deductions and income and things. Like, what should we be looking at as the end of the year quickly approaches?
Yeah. So there are certain deductions that may not, that have ceiling, may have floors, meaning you have to have enough of a percentage of your adjusted gross income for that to be deductible to you. It needs to be a large enough amount. And so you may not be able this year to do it. And so what you may want to do is not take the deduction this year so you can bunch it next year.
Gotcha.
Or if you didn't do it last year, you're bunching it into this year. Mortgage deductions are a version of that. What you can do with that is you can bunch it into property taxes. You can pay your property taxes in January of next year instead of paying it this year, and then pay your property taxes for next year.
Yeah.
So now you're doubling up on your property taxes. And by doing that, it may get the number high enough to where now you can deduct it. When if you try to deduct it, if you paid your property taxes this year, you got no deduction for it. You pay it next year, no deduction.
Yeah.
But if you don't pay it, you pay it in January, you bunch them together, now you got a deduction that you didn't have before. So that's another way of, so this isn't one of those use it, you lose it. This is one of those maybe you don't use it and you double up next year.
Yeah.
And there are other versions of that, but that's an important consideration, is looking at shifting income into next year versus having it this year, or losses next year versus having them in this year.
Very good. All right, well that is 5 items already.
5 items, so part 1's done already?
Part 1 is done.
Oh, I'm gonna cry. I was having more fun than a human being should be allowed to have, Jeremy. Well, folks, I hope you enjoyed part 1, and as usual, we always would love it if you'd like and subscribe. It helps us out a lot, and that way you never miss any of these episodes, and particularly, you don't miss episode number 2. So as always, I hope this found you healthy, wealthy, and wise, and I look forward to seeing you on the other side with part 2.
Retirement Planners of America.